So I just unboxed the new microphone that I had showed you guys earlier, and I recorded a little clip and I went back to hear it, and it sounded so crisp, like way better than my earplugs that I connected to my phone. And it was just a hassle to just get the phone audio file to the computer. That took like, I don't know, like it felt like an hour, but it probably was, to be honest with you. Oh, I gotta move this a little bit. Okay. But yeah, this thing sounded so good, I just had to make a video right now. Matter of fact. Okay. Alright. So we're just gonna get straight into it. We're doing a trade recap of April 24th's trade on gold. I just need to find it. It was here. Yep. That's it. Yeah, it was right here. So if you guys remember from my previous video about, actually let me break it back down. Here is April 24th. You have 7 a.m. to 12, which is 6 to 11 my time. I have the picture right here that we're gonna be looking at. Just need to open up the other one so I can see what I'm. Oh, okay. Because I do tend to forget the trades that I do. Those are the ads I was talking about from last video that you guys couldn't see. But I do need to get the subscription for TradingView. So, yep, this is, yeah, right here. Okay. So, here was the sell stops. Price came down. It didn't close below this. That's one thing that's really important. You don't want price to close below the sell stops. That just tells me it's continuing down. I want it to be a sweep. I want it to come down and then come up, right? So on these red candlesticks, these are bearish candlesticks, right? They open at the top and close at the bottom. And these wicks, they just tell you where price went, but it did not close or open there. I'll go over it better in my beginner's course that I'll be making soon, I believe. But for now, I'll just leave you with bearish candles close at the bottom and open at the top. And these green candles, they are called bullish candles. They open at the bottom and close at the top, right? So back to this candle. It opened here, came down. It came down here, but it retraced back up. It went back up, and it closed above the sell stops. It just came and did a sweep of this liquidity, of these sell stops, right? So after this happened, it came to my 5-minute chart. Nope, I'll be going over that trade as well. That was a loss. It's okay to lose. It's just a part of the process. Where did this thing go? Oh, right here. Okay. Here we go. Here's this block. I'm gonna get rid of this for now. This is from 7 a.m. to 12 a.m. So price, these are the sell stops. Price came down, and as you could see, it came down and swept them and then came back up, right? So now we wait for my pattern, right? So, alright, we wait for my pattern, right? So 7 o'clock hits, now I'm looking at the market. So I see this, where's my brush at? There you go. Price is coming down, coming down. So what I want to see is this, right? This happen. I will show you guys better. Go down here. Let me see it. Where's the path? I need the path. Here, it should be here. Yep. Okay, let me just save this. Boom. So this is what I want price to do, right? It goes down, up, down, up, down, and then boom, right? Make this a little cleaner. So price is making lower highs, lower lows, lower high, lower low, lower high, lower low, and then it breaks this, making a higher high, right? And then after this, I want price to retrace and then continue up. So when you see my trades like here, right, you can kind of see this pattern, right? See right here, lower, nope, yep, lower high, lower low, lower high, lower low, lower high, lower low, and then it broke, making a higher high, then came back to retrace to my zone and then continue, right? So this is what we want to see here, right? You have this break and then the Fibonacci I was telling you guys about, just extend that, and then we'll have it retrace somewhere in this. There'll be like a fair value gap or an order block plus this optimal trade entry zone, and then continue up for, in this case, a 1 to 2. All right, so this is what I'm looking for overall. This is the a buy example, right? Because I bought. So back to the charts. So as you can see, there's a high, there's a low, a lower high, lower low, lower high, right? Even though it's almost the same, it's still lower than this, right? It's still lower. So that's a lower high, lower low, all right? Boom, you have this liquidity grab. Yeah. And then I always look at the, so I know there's a few different highs, right? You have this one right here, you have this one, and you have this one. I always look for the highest one, right? Because sometimes there's a lower one that does get broken, but it's not good enough and the trade reverses. And speaking of which, since I'm talking about it, I will tell you about this trade that I actually took today that I lost, right? Nope, that's definitely not the one. That's a win here, right? As you can see, I put this in my text while I after I had lost, right? So let me break this down. I guess you're getting 2 trade recaps in one, but I'm also gonna make a separate video for this. You have these sell stops, right? Price came down, it swept it, right? So after price swept, I came to my 5 minute, and then I looked for my pattern, right? It was this high, low, lower high, lower low, lower high, lower low, and then boom. So when I looked at this, right, I thought, oh wow, this looks like a trade setup because there's an impulsive break, there's an impulsive move up. Impulsive meaning it's very straightforward, it's more green candles than red, right? It was an impulsive move up. I'm like, oh, and this high got broken, so I'm just gonna, price was literally right here where my mouse is when I decided I'm gonna get into this trade. Now, there's two reasons why this was a bad idea. One, I had a emotion of a fear of missing out. It's a short way to say this, FOMO. You know what I mean? A fear of missing out. You have to understand that there's always other days for opportunities. You shouldn't ever put your trading career into one trade. You know what I mean? Like, oh my gosh, I lost this trade, it's over with, I'm a failure, I'm this, I'm that. You know what I mean? It's not, when it's not healthy, and two, it's just a bad trading psychology. You know what I mean? Strategy is like 20% of trading. 80% of the rest of 80% is literally trading psychology. It's incredibly important because of things like this, right? I got too ahead of myself. My heart was racing. Oh, I'm gonna miss this trade. Oh. And then whole time there was no trade because, like I was just explaining, in this trade, right, I always go for the highest high that I could find. You know what I mean? And in this case, it was this one. And this one didn't even get close to break. I mean, it got close, but you know what I mean? Price would have had to been up here for it to be really an impulsive break. You know what I mean? Or even just a little bit. You know what I mean? For it to just close up here and then retrace. Then it would have been a trade, right? But it did not. I called this a market structure shift or break of structure, and then I saw this. I'm like, oh, okay, I'm definitely going to win this one. Nope. As you can see, it went down, and it is still doing its thing, right? Yeah, so trading psychology, very important. Always stick to your trading plan, and if you don't have a trading plan, you should not be trading. You should always keep a notepad of what rules to follow next to you while you are trading. And I have one, but I don't have it out, actually. It's underneath this stack of papers. That's besides the point. But yeah, trading psychology, very important. Anyways, back to April 24th. April 24th. Here we go. I need a water bottle. Hold on. Okay. Alright. Back to the video. April 24th, right? So so let's go back over this again. High, low, lower high, lower low, lower high, lower low, saw this liquidity grab, and then boom. You see this? Impulsive move. It's a very impulsive move. It goes straight up, except for these two candles, but for the most part, straight up. You know what I mean? So this is the high that got broken, and then after this got broken, I'm like, okay, looks good. I'm gonna use my Fibonacci tool, and this was the highest point so far. You know what I mean? And then I wanted, I actually entered. It was a combination of my optimal trade entry zone, which was this zone, if you remember from the last video, the 0.62, the 0.705, and the 0.79 of this range from the top of the bottom of the impulsive move, and then the top of the impulsive move, right? It was a mix of this OTE, optimal trade entry zone, and this order block, right? It's an order block is just a block of orders before the impulsive move up. And I'll go over all of these concepts: liquidity grabs, stop raids, market structure shifts, optimal trade entry zones with the Fibonacci, I said order blocks, fair value gaps, maybe inverse fair value gaps. I don't really use them that much, but maybe I'll insert them. But all of these concepts I'll go over in my strategy that I'll be creating videos of, and it'll be posted for free on YouTube. So there's that. But for the meantime, this is just the trade recap. Yep, I'm still recording. Okay, good. So yeah, so could get rid of this. That's the optimal trade entry zone, and then you have this order block, right? I think I have a, yep. So OB plus, I'll just put a plus there, meaning bearish order block. You also have bullish, sorry, bullish order block. And then you have a bearish order block, you know what I mean, if it went downwards, but in this case, oh, alright. It's crazy, I saw that I did that before I even did it. It's kind of funny. Okay. Back to this, and then, but for this example, it's a bearish order block. But I don't really, use these, like, as much as I probably should. I just see it with my eyes for the most part, but I just like mark it out like this, just as like a mental note before I enter the trade, like, okay, these are the reasons. But for the most part, I don't really use these rectangles. I do use this and these and these, but yeah, for the video I'll do this. So yeah, so you saw price came down, and then it didn't hit my order block, right? So I'm like, okay, that's fine. Another thing you have to understand is if price doesn't hit your zone, it's really not the end of the world. So even if you ever miss a trade, it's okay, because the strategy proves itself. You know what I mean? There will always be other opportunities. The markets are not going anywhere. The strategy isn't going anywhere because it follows the algorithm that moves the markets. You know what I mean? Like, it's okay if you miss a trade. It really is. It's not the end of the world. And it's easy to say in hindsight, but as you can see by my example of today, everything is different when it's in the moment. Right here. Everything is always different when it's in the moment, but that's why you should always keep a piece of paper of all of your rules that you should follow when you trade, even if it's just psychology tips, like don't overtrade, trade once a day, don't have a fear of missing out, you know what I mean, like things like that. Just always keep that in mind. It's good things to practice. But yeah, so the price after this came back up and then hit my order block perfectly. So I entered here, stop loss. I know I say like below this, like from excuse me, like from yesterday's video, I said, not yesterday's, but the last trade recap of April 19th, I said to like put it at this low. But if there's a low lower than this one, I just like to be safe and put it at that one, at that low. And then obviously 1 to 2, 1 to 2, and boom, came up, went down, and then boom, smashed the take profit. So there's that recap. And something that people like to do, so you have this range, right? You have sell stops and you have buy stops, right? It's a range of liquidity. How it usually goes, how it almost always goes, as you can see, especially in this example, one side gets swept, there's a pattern at the bottom, and it targets the other side. So what people like to do is they like to just target the buy side. The opposite side. In this case, it's the buy side, right? So that would be a 3.4 risk-reward ratio. The risk-reward ratio. It's a tongue twister. But yeah. And to remind you, I always risk 1%. So if I lose, it's only 1% of my account. And in this 3.4 risk to reward ratio, I would get 3.4% plus 3.4%, right? That's just how it goes. Or if you do 2%, then you get 6.8%, etc. You know what I mean? So in my case, I always do 1 to 2. It's just to be safe, I do 1 to 2, but more often than not, the opposite side gets swept. You know what I mean? So yeah, it's just whatever you prefer. Some people like to do it 1 to 1. Some like to do 1 to 2, like me. And some people only trade 1 to 3 risk to reward ratios. If it's not a 1 to 3, then they don't trade it. But yeah, for me, 1 to 2, always 1 to 2. That's just how I like it. But yeah, I'm trying to think of anything else I could bring up. I guess I could talk about risk management a little bit. The reason why I risk 1%, I guess I don't even need to type this actually. The reason I risk 1% is because in order for me to blow my account, blowing your account means you lose all the money in your account. For me to blow my account, I would need to lose 100 trades in a row. And that's just not possible. It's very much possible, but there's no way. There's just no way. There's just, I don't know how else to explain it. There's no way. You know what I mean? If you lose 100 trades in a row, you need to go way back to the drawing board. You don't, not even like the chalkboard, the drawing board. You need to put chalk on the ground, on concrete, to draw up how you're gonna do this, how you're gonna go back to the markets. And the best thing about trading is you don't even need to lose money. You can start paper trading. You can trade with fake money when you begin. And I know everybody wants to be like, I want to just learn trading so I can make money fast. And it's like, it could very much be fast, but it could also very much not be fast at all. And you have to treat it like, at least give it like a year or two. You know what I mean? At least a year. I would say at the least a year. But, you know, it just depends on who you are. If you're really consistent, you can easily learn in 6 months. Even like 4 months. You know what I mean? If you're learning the right things. There's a lot of quote unquote education out there, but it's just to rack up views and affiliate marketing, sales and things like that with like indicators and stuff. And I just always recommend learning price action, learning what all of this is, these concepts, liquidity sweeps, breaks of structures, market structure shifts, what times to trade, learn about the sessions, New York session, London session, Asian session, just everything. You know what I mean? Learn how price moves, learn what the algorithm does on a daily basis. Just watch the markets. You know what I mean? You don't even have to try to predict it. Just watch it and just watch it. You know what I mean? It might not be so fun to just stare at these markets. You know what I mean? Like right now, markets are live. Like imagine just looking at this and just waiting for something to happen. Or just looking at it and seeing what you could learn from it. It's gonna take a long time, and that's okay. But it's not supposed to be fun, you know what I mean? But if you're really passionate about it, it could definitely be fun. If this is what you think, what you know will create your money, then it'll definitely be fun for you. It was fun for me, you know what I mean? It was very fun because I knew, and you should know too, if you don't quit, it will always work. If that makes sense. Like, you can't lose if you don't quit. You're only a loser if you quit. You know what I mean? Like, nothing's a loss unless, I mean, you can't lose if you learn from your mistakes. You know what I mean? Like, yeah, I lost money right here, right? I lost 1% of my account, but the lesson that I learned the lesson I learned is worth way more than this 1%. Because money comes and goes anyway, but that's a different conversation. Yeah, I'm kind of rambling here, but this was the trade recap with the brand new mic. Sounds so good. Sounds amazing, actually. A lot better than I thought. If you have any questions, feel free to leave them in the comment section. Check out my socials because I figured out why I couldn't. I've already figured out why I couldn't post a link. That's because my account wasn't verified, but now it's verified, so I can post links. But as to why you couldn't comment, it's because for some reason my account was it was said to be made for kids, and apparently on kids videos you can't comment. So I looked it up on YouTube and I looked up why can't people comment on my video, and that's what popped up. So I changed it. Now this channel is not made for kids, quote unquote, on paper. So you can comment now. So feel free to comment, and definitely check my other social medias out. I'll be posting more on my Telegram for sure. I'm just trying to think of what. I could post my live trades, but definitely follow the TikTok because I want to get enough followers, that way I can go live and then start showing you guys me live trading, and I can answer questions while I'm on live and stuff, so that'll be fun. That'll definitely be fun. But yeah, it's 1:21 a.m. for me. Whatever time it is for you, I hope you have a good day, good night, good morning, whatever it is. And yeah, peace out.